So hello everyone, and I hope everyone is well. So on chapter 2, where I kind of left off was, this is the money market, right? We left off here. Here was the drawing we looked at. And the money market, it's a market for like short-term liquid securities. And you notice the magic word here is maturities of 1 year or less. So the money market basically exists because some individuals and or government businesses and other financial institutions have temporarily idle funds. They have money they want to put aside, and some of you may have that too, right? You have some money short term, and you don't want to take a risk putting it in the securities markets. All right, so you notice there's a magic word here again called marketable securities, and these are short-term debt instruments, treasury bills, commercial paper. Commercial paper is when companies loan to each other. They call that commercial paper, short term, less than 270 days, okay? And, negotiable CDs, like, you know what a CD is, correct? You go to the bank and you get a 1 year or a 2 year or a 3 month, whatever, CD, okay? So those are called marketable securities, okay? So there's an international equivalent of the money market, and it's called the euro currency market. And these are nice. These things are clickable, and of course, all these you can go to YouTube and there's videos on all these. So this is basically the international equivalent of the domestic money market, and the deposits are in U.S. dollars or other major currencies. So, you should read this. So if a multinational corporation were to deposit U.S. dollars in a London bank, this action would create a euro dollar deposit, okay? So it's that straightforward. Okay, so the next term is the capital markets. And these are securities, right? This is when you invest money in securities a year or longer. So, you would invest in bonds or stocks, right? Bond and stock transactions. And let's click here and you'll see what it says, right? A market that enables suppliers and demanders of long-term funds to make transactions. And what's traded again is bonds and stocks. Now, we'll learn a lot more about bonds and stocks in the upcoming chapters. A bond is when you loan a company money. Well, it's as simple as, let's say you have a friend or a relative and they need money, and you loan it to them, and you promise to pay it back, and you'll give them a little interest and stuff, okay? And it's different than a stock, because when you buy stocks in a company, it represents ownership, right? So this is what a bond is, and let's click that. Long-term debt instrument used by businesses and government to raise large sums of money. All right, so here's common stock. So a unit of ownership or equity. So most of the time you get voting rights, and they may or may not pay you a dividend. I own Amazon.com. I don't get a dividend, but it's been going up, right? I own Apple, but they basically do pay a dividend. So some stocks do and some stocks don't. If you're ever going to trade in the securities markets, that's one of the questions. So you'll notice here, firms have no obligation to pay dividends on common stock, and in fact, most young firms tend to reinvest their earnings rather than pay them out as dividends. Now you notice there's another term here called preferred stock, and preferred stock is basically it's a special form of stock, and the periodic dividend is fixed, okay? And basically, you'll notice the word preferred means that any dividends on preferred stock must get paid prior to the common stock. So common stock is taking the most risk, okay? So preferred stock, again, is just what it says. And it's kind of called a hybrid. You'll notice the word hybrid here. That has features of both a bond and a common stock. And it's worth reading up on these. Firms promise to pay preferred stockholders a fixed periodic dividend, much like the fixed interest payment that bonds offer. Firms must also pay dividends to preferred stockholders before they pay dividends to common stockholders. And so there's a preference over a common stock. By the way, the order of preference, if a company's in trouble, right? Bonds are on top, and any money owed to companies that, loans that the company has get paid next, then the preferred stockholders, then the common stockholders. So this is low on the totem pole, and, they bear all the risk. All right, so market prices of common and preferred stocks, as you were aware, fluctuate. But because preferred dividends are fixed, whereas firms may increase or decrease dividends on common shares, common stock prices tend to fluctuate more. And they got a little focus on practice. Berkshire Hathaway, I think Berkshire Hathaway stock is, it's well over $270,000 a share now. You can Google that. You can see how much a share is worth. Just type BRKA. You see the stock symbol? Type price of BRKA. So let's talk about the words broker markets and dealer markets, okay? All right, so you'll notice they said the vast majority of trades take place in the secondary market. Again, that's between you and me. We're in the secondary market, all right? You and I trade amongst each other. And, you can go to Yahoo Finance, and there's a lot of good stuff on Yahoo Finance to learn about finance. And let's look at the word liquidity. The ability to quickly buy or sell a security without having an impact on the security's price. So if something in general is very liquid, there's a lot of it, okay? And you won't affect the price too much. All right, so when one places trades on the secondary market, which is what we will do, unless we do it by, initial public offerings directly from the company. So you basically must know there's online brokerages, right? And the brokerage charges the investor a fee called commission. Now, if you go online, a lot of brokerages have stopped charging commission. So the simplest type of trade involves a market order, okay? An order to either buy or sell a security at the prevailing market price. And that's what I usually do. I buy them right away, which is an order to either sell or buy a security at the current price, all right? And, securities have two prices, buy and sell or bid and ask, okay? So the bid price is the highest price a buyer in the market is willing to pay for a security, and vice versa, the lowest price a seller in the market is willing to accept. And that's called a spread between the bid and the ask. So in effect, an investor pays the ask price when buying securities and receives the bid price when selling them. So let's look here and see what's going on here. All right, this is worth watching.
Market makers provide quotations for securities trading in the secondary market. Quotations are comprised of a bid and ask price, where the bid price is the highest price a buyer in the market is willing to pay for a security, and the ask price is the lowest price a seller in the market is willing to accept for a security. Typically, when investors want to buy or sell securities, they submit a market order, which is an order to either buy or sell a security at the prevailing market price. Market orders are submitted by a brokerage firm that then route the order to a market maker for execution. In addition to specifying whether the trader wants to buy or sell securities, the market order also specifies the specific security and desired quantity. In this example, Mark submits a market order to buy 100 shares of Facebook common stock. At the time Mark places the market buy order for 100 shares of Facebook stock, the ask price is $138.79. So Mark will have to pay $13,879, which is the ask price per share times 100 shares being purchased. Mark will also have to pay any associated brokerage fees. If instead Mark wishes to sell 100 shares of Facebook, then he would sell shares at the prevailing market bid price using a market sell order. Since the current bid price for Facebook is $138.71 per share, Mark would receive $13,871 for 100 shares less any associated brokerage fees.
All right, so since I mentioned it before, so the difference between the bid and ask prices is the bid-ask spread, and you can see that right here, right? Bid-ask spread, right? So basically, a market maker is he gets the bid-ask spread. They make markets by offering to buy or sell certain securities stated, and that's different from the commission. Okay, that's different from the commission. All right, so there's two words you kind of have to know here. The essential difference between a broker and dealer markets is a technical point that deals with the way trades are executed. When a trader occurs in a broker market, the market maker brings the buyer's order and the seller's order together to execute the trade at the midpoint of the bid-ask spread. So they do that, right? It's done at the bid-ask spread, right? In other words, party A sells his or her securities directly to the buyer. Note that this kind of market will have a high degree of liquidity. All right, so the dealer market is the buyers and sellers orders are not brought directly together. Instead, market makers execute the buy and sell orders they receive using their own inventories of securities. So this is done. This is the definition of a dealer market. The market in which the buyer and seller are not brought together directly, but instead have their orders executed by securities dealers who make markets in the given security. Okay, so just remember that difference: a broker market and a dealer market. All right, so there's a nice little personal finance example here, right? That you should go through, and it's worth doing. And let's watch this example, and it's very interesting.
Who provides the liquidity, i.e. the other side of the transaction, affects investors' trading costs. In a broker market, the two sides of a transaction, the buyer and the seller, are brought together to execute the trade, whereas in a dealer market, the two sides of a transaction are not brought together, but instead the two sides of the trade are executed by dealers. The key difference between broker and dealer markets is whether other traders or dealers provide the liquidity. In broker markets, the orders from other investors provide liquidity, and in dealer markets, the dealers provide liquidity. Because dealers have to maintain a costly inventory to provide liquidity, the total transaction costs that investors pay when buying or selling securities will differ depending on whether the trade is executed in a broker or dealer market. In a broker market, when opposing orders are matched to complete transactions, the transaction price is the midpoint of the bid-ask spread, so the total transaction costs equal only the brokerage commission. In a dealer market, when orders are filled using securities from the dealer's inventory, the transaction price is either the bid or the ask price. This means that in comparison to buy and sell orders that are matched in a broker market, buy and sell orders executed by dealers pay an additional 1/2 of the bid-ask spread, or a half spread. It's this additional half spread that compensates the dealer for providing the liquidity necessary to execute the trader's trade. Recall that the midpoint of the bid-ask spread is commonly viewed as the security's market value, so in a broker market, the transaction price is simply the market price, but in a dealer market, the transaction price is the market price plus the half spread. In this example, suppose that you want to place a market buy order for 100 shares of Merck & Company stock through an online E-Trade brokerage account that charges a flat commission of $6.95 for equity trades. The current market prices for Merck are a bid price of $63.25 and an ask price of $63.45. Subtracting the bid price from the ask price, we find that the bid-ask spread for Merck is 20 cents. It is worth noting that the midpoint of Merck's bid-ask spread is $63.35, so we could say that Merck's market value is $63.35. Depending on where your brokerage routes your order, you find that your total transaction costs are either $6.95 in a broker market or $16.95 in a dealer market. Whether your broker routes your order to a broker market like the New York Stock Exchange or a dealer market like the NASDAQ Stock Exchange.
All right, so you can watch that whole thing later. I'm going to cut this off now. All right.